Welcome to the tutorial on managerial accounting. This is the fourth tutorial on master budgeting. This is the final tutorial on master budgeting. In this tutorial, we are going to discuss on budgeted income statement and budgeted balance sheet. In the previous three tutorials, we have covered the previous budgets, that means sales budget, production budget, ending inventory budget, selling and administrative expense budget, material budget, labor budget, overhead budget, cash budget. And in this last tutorial on master budgeting, we are going to learn about budgeted income statement and budgeted balance sheet. We will prepare these two items under master budgeting by taking data from the previous budgets and by taking data from the beginning balance sheet. We can see this is the beginning balance sheet. From the balance of beginning balance sheet, we will prepare the budgeted balance sheet as well as the budgeted income statement. Now we are going to prepare the budgeted income statement, and for preparing the budgeted income statement, we will take data from the beginning balance sheet as well as we will take data developed in the previous budgets. This is the budgeted income statement. In the first line, we can see sales. Then we can see we need to deduct cost of goods sold to get the gross margin. After that, we will deduct the selling and administrative expense to arrive at the net operating income, and from that balance we will deduct the interest expenses to arrive at the net income, and the amount of sales will be taken from the sales budget. This is the amount of sales, and this amount would be taken from the sales budget. This is the sales budget which was prepared in the previous tutorial, and we can see our total sales in the year column. This is the amount which should be taken to the budgeted income statement. So this sales amount has been taken from the sales budget from the total year column. Then we can see cost of goods sold. This cost of goods sold can be calculated by multiplying the unit product cost with the units sold. We can see cost of goods sold. We have sold 100,000 units. This amount is taken from the sales budget, and we know the unit product cost is 13 per unit. This amount is taken from the ending finished goods inventory budget. If we multiply this 13 per unit, this is the unit product cost, and this is the 100,000 units sold. If we multiply the units sold with the per unit product cost, we will get the cost of goods sold. This amount has been taken from the sales budget. We can see this is the sales budget and this is the unit sold, and we can see 13 per unit, it is the unit product cost, and it has been taken from the ending finished goods inventory budget. We can see it is the ending finished goods inventory budget, and here the unit product cost is 13. In the previous tutorial, we have learned how to prepare the ending finished goods inventory budget, and from that budget we are taking the unit product cost, which is 13. That means by multiplying the 13 per unit product cost with the units sold, we will get the cost of goods sold. And if we deduct the cost of goods sold from the sales, we will get the gross margin, which is 700,000. And from this gross margin, we need to deduct the selling and administrative expense, and this amount can be found in the selling and administrative expense budget. We can see this is the selling and administrative expense budget, and from this budget we can see our total selling and administrative expense in the year column is 576,000. So if we deduct this 576,000 as a selling and administrative expense from the gross margin, we will get the net operating income, which is 124,000. And from that net operating income we will deduct the interest expense, and this interest expense can be found in the cash budget. We can see this is the cash budget, and our interest expense total 21,900. This interest expense should be deducted from the net operating income. So if we deduct this 21,900 from the net operating income, we will get the net income, which is 102,100. And this is the process of preparing the budgeted income statement. Now we are going to prepare the budgeted balance sheet. The data for budgeted balance sheet will be taken from the beginning balance sheet of the period and data from the previous budgets. And we can see this is the beginning balance sheet. Data will be taken from this beginning balance sheet to prepare the budgeted balance sheet. In the first line we can see cash. So this is the balance of cash for the beginning balance sheet, but now we are going to prepare the budgeted balance sheet, which will be prepared with the closing balance of each accounts. I am repeating, we will prepare the budgeted balance sheet by taking the closing balance of accounts. These are the balance sheet with the opening balance, but we are going to prepare the budgeted balance sheet with the closing balance. This is the budgeted balance sheet, and in the first line we can see we will write the cash balance, and this cash balance will be taken from the cash budget. Here we can see our closing cash balance is 41,400. I would like to repeat one important thing, that is we will prepare the budgeted balance sheet with the closing balance of all items. And for preparing this budgeted balance sheet, we will take data from the beginning balance sheet as well as from the previous budgets. However, we can see our first item is cash, and the balance of cash is 41,400. This is the closing balance, and this will be taken from the cash budget. We can see this is the cash budget, and our closing balance is 41,400. This is the closing cash balance, which will be shown in the budgeted balance sheet. So our cash balance is 41,400. Next we can see accounts receivable. This data will be taken from the schedule of expected cash collections. This is the schedule of expected cash collections, and we can see in the fourth quarter we have sold 400,000, and from this 400,000, according to the policy, 70% will be received in the particular quarter and remaining 30% will be received in the next quarter. Since our fourth quarter remaining collection would be 30%, which would be collected in the next year first quarter, that's why the 30% of 400,000 would be considered as accounts receivable. That means the 30% of 400,000 would be 120,000, and this 120,000 would be considered as a accounts receivable, which will be shown as a current asset in the budgeted balance sheet. So we can see in the budgeted balance sheet our accounts receivable balance is 120,000. Next we can see raw materials inventory, and the balance of this raw materials inventory will be taken from the direct material budget. This is the direct material budget, and our closing raw materials equals to the 22,500 units, and our cost of raw materials per pound is 0.20. If we multiply this closing units 22,500 with the 0.20, we will get the closing balance of raw materials inventory. That means if we multiply this 22,500 pounds with the cost per pound, I mean 0.20, we will get the raw materials inventory balance, which is 4,500. So in the budgeted balance sheet, our raw materials inventory balance would be 4,500. Next we can see finished goods inventory balance 39,000, and we will get this amount from the ending finished goods inventory budget. This is the ending finished goods inventory budget, and we can see our ending finished goods inventory balance would be 39,000. So here we have shown 39,000 as a balance of finished goods inventory. So these are the current assets in this budgeted balance sheet. If we sum up all the current assets, our total current assets would be 204,900. Now we are going to show the plant and equipment. Here we can see land, building and equipment, and then deduction of accumulated depreciation to get the net plant and equipment. The beginning balance of this item will be taken from the beginning balance sheet. This is the budgeted balance sheet, but we will take the balance from the beginning balance sheet and then we will adjust. This is the beginning balance sheet. From this beginning balance sheet, we can see the balance of land is 80,000. In the previous budgets, there is no addition or deduction in the land asset. That's why this asset would be considered as closing balance in the budgeted balance sheet. So this is the budgeted balance sheet. We can see the land amount would be 80,000. Then we can see buildings and equipment. Here we can see the closing balance is 830,000. This amount would be taken from the beginning balance sheet, as well as if there is any purchase, then those purchase would be added with this building and equipment. We can see from the beginning balance sheet, our opening balance of building and equipment is 700,000, and from the cash budget we can see there is a equipment purchase which is total 130,000. This 130,000 would be added with the opening balance of equipment. That means our opening balance is 700,000, which is taken from the beginning balance sheet, and our purchase of equipment is 130,000. Total closing balance of building and equipment would be 830,000. So our balance of building and equipment would be 830,000. From this amount, we will deduct the accumulated depreciation. To get the balance of accumulated depreciation, we will get the opening balance, then we will adjust any addition of depreciation. This is the beginning balance sheet. We can see our balance of accumulated depreciation is 292,000, and from the manufacturing overhead budget we need to add this depreciation, which is 60,000. With the opening balance we will add this depreciation for the manufacturing overhead. As well as in the selling and administrative expense budget, we can see depreciation, which is 40,000. So this 40,000 from the selling and administrative expense budget, 60,000 depreciation from the manufacturing overhead budget, and here opening 292,000. Ultimately our total accumulated depreciation would be opening balance 292,000 and depreciation for manufacturing overhead 60,000 and depreciation for selling and administrative expense 40,000. Total 392,000. So if we deduct this accumulated depreciation 392,000 from the total plant and equipment, here 80,000 plus 830,000, our net plant and equipment would be 518,000. So this is the total plant and equipment or long-term asset, and this is the current asset. Another name of long-term asset is non-current asset. The amount of non-current asset is 518,000 and amount of current asset is 204,900. If we add these two items, I mean the current asset as well as the plant and equipment, then the total assets amount would be 722,900. Then we are going to show the liabilities and stockholders equity. in the initial stage we will show the current liabilities, then we will show the long-term liabilities if any, then we will show the stockholders equity. After that we will add the liabilities and equity. However, we can see accounts payable, and this balance of accounts payable would be taken from the schedule of expected cash disbursement. This is the schedule of expected cash disbursement for purchase of materials, and we can see in the last quarter, I mean in the fourth quarter, our purchase of raw materials is 55,800, and according to the policy we can see the company pays the 50% in the particular quarter and the remaining 50% in the next quarter. That means 50% of 55,800 would be 27,900. This amount would be paid in the fourth quarter, and the remaining amount, which will be considered as accounts payable. I am repeating, the remaining 50% of the fourth quarter purchase of materials would be considered as accounts payable. So our amount of accounts payable would be 50% of this 55,800. That would be 27,900. So this accounts payable amount would be 27,900. It would be shown as a current liabilities. Then you can see we will write the stockholders equity. In the first stage we can see common stock, and let's see the beginning balance sheet for the balance of common stock. So we can see in the beginning balance sheet our balance of common stock is 175,000, and there is no addition or deduction in this common stock. That's why this balance would be shown in the closing balance sheet, I mean in the budgeted balance sheet. This is the budgeted balance sheet, and we can see we have shown the same balance common stock because there is no change in the common stock. That means our balance of common stock is 175,000. Then we can see retained earnings. Here the closing balance in the budgeted balance sheet of retained earnings is 520,000. We will get this amount from the beginning balance sheet as well as the addition and subtraction which will be taken from the previous budgets. And from the beginning balance sheet we can see our opening balance of retained earnings is 449,900, and with this amount we will add the net income, and net income amount would be taken from the budgeted income statement. And this is the budgeted income statement. We can see our amount of net income is 102,100. We will add this net income with the opening retained earnings, and from the retained earnings we will deduct the dividend payment. We can see from the cash budget our payment of dividend is 32,000. This dividend payment would be deducted from the retained earnings to get the closing balance of retained earnings. That means we can see in the first line we will show the beginning balance of retained earnings, which is 449,900. Then we will add the net income, which will be taken from the budgeted income statement, which is 102,100. And if we add these two items, we will get the 552,000. And with this 552,000, we will deduct the dividend payments, and this amount would be taken from the cash budget. The amount of total dividend payment is 32,000. After deducting this dividend payment, we will get the closing retained earnings balance, which is 520,000. So this is the retained earnings closing balance, which will be shown in the budgeted balance sheet, which is 520,000. So this is the retained earnings balance, and this is the common stock. So total equity would be calculated by adding these two items, which is 695,000. This is the total equity, and with this equity we will add the liabilities, which is 27,900. This current liabilities and this equity total 722,900. So our total balance of liabilities and equity is 722,900, and our total assets is 722,900. So here total assets equal to liabilities plus equity. I am repeating, when the assets are equal to liabilities and equity, the balance sheet is okay. In this way we will prepare the budgeted balance sheet. If you prepare your budget in the Excel sheet, then if there is any necessity to change any amount because all the amounts are estimated amount. That's why if there is any situation in which you need to change any amount, then you can change it in any place automatically if you use the formula in all the sheets in the Excel for all the budgets. Then with the change of any amount, all the remaining amount will be changed automatically, and from these facilities you can get idea of the income as well as the balance of assets and liabilities for the changes in any estimated amount, I mean change in sales or any other expense. And if you show the budgets to the bank, then the bank will be satisfied and they will get idea when you can pay the loan with the interest. That's why if you prepare the budgets in a Excel sheet, and in any situation if you change any amount, all the remaining amount will be changed automatically due to the use of formula in the Excel sheet. And by this way you can check the impacts of any changes in any estimated amount to the rest of the balances in the budgets. Thank you.